Okay, now I'm going to talk to you as an investor for a few minutes. And this is a question I've always wanted to ask you, because you've been very clear about what you look at when you look at an investment. But I have a feeling that there are things that you don't look at that other people do look at, that there's a lot of noise in the data that other people rely on. So are there things that you specifically think that other investors do look at that you think are irrelevant?
Well, I certainly don't think about the quarterly prospects or what they're going to earn next year. I mean, in the end, I really look at it like buying a farm. What's it going to produce? And do I have an honest and able farmer managing it for me? So I try to stick with businesses that I think I can understand. And by understand, I mean that I have a pretty good fix on 5 or 10 years from now what their competitive position will be. Whether they have a moat around them in some way that's protecting their earning power. And when I find ones that qualify, that are in what I call my circle of competence, then I focus on the people running them and what I have to pay for them. And it's just like buying a business. When I buy a stock, in my mind, I'm buying a little piece of a business, which is how I want people to think of when they buy Berkshire. So I don't want to buy 100 shares of a stock if I wouldn't buy the whole business at that price. It's very simple.
Let's talk for a minute about May 6th, where the stock market went completely gaflooey for a moment. What are you thinking as you're watching the ticker?
Well, it happened so fast. I thought maybe it was a cyber attack of some sort, too. I mean, because maybe we'll have one someday, probably. Anything that can happen will happen. If you're in the insurance business, you get an appreciation for that. But it didn't change anything I do. I don't care what our stocks sell for, except I love it when they sell cheap, and we can buy more. But I've never understood this passion for liquidity, and Keynes wrote a lot about that. He said it's one of the misguided goals of markets, is this idea that you want enormous liquidity. So, that shouldn't have made any difference to anybody, except somebody had them order to buy in much lower, and then they bought it, and then it got canceled on them. That might be upsetting, but the mechanics, as far as I'm concerned, there's way too much stock trades. I mean, it would be a better stock market if it was like it was 40 years ago, when turnover was 20 or 25% of stocks. The more it's become like a casino, that's not the friend of the investor.
I agree with you. Do you think that that's in part because of sort of an automated thing? Do you think those were sort of robot investments that piled onto each other?
Well, there's some of that, and I don't really understand it perfectly. But I think also that investors, the institutional investors, generally have been less sensible than individual investors. I mean, back when I started selling securities, individuals owned a lot, and they really bought them to own. They bought them with the idea they were going to hold it 5 years or 10 years from that. And institutions, basically, if they think they're trying to beat the S&P every quarter or something of the sort, they're not going to do it by activity, but they are convinced that they need to do something like that. And there's much more selling of it. There's much more presence in their lives. I mean, with CNBC on all day and Fox Business News and so on. So there's this feeling you got to do something. Now, if I bought a farm and there was a farm channel, and and every 5 minutes they said, maybe it's going to rain this afternoon. How do you think the rain will end up be at the close today? And you got to make a decision on whether to keep this farm and what's going to happen with soybean prices next week. It stimulates activity. And the gambling propensity is strong in people anyway. I mean, decades ago, people would go thousands of miles to some place in the desert, to do mathematically unintelligent things, gambling. And these were people with decent IQs. So there's a big element of that in people. Now when you get it so you can do it, sit there at the internet and punch in orders and do all of that, it's been made a lot easier to turn what should be a market for businesses into a casino. And there's a combination of both that exists.
One of the things that concerns me about that exact issue is that these large institutional investors should be the ultimate long-term holders, especially pension funds. They get 30 years from the day that the penny comes in to the day it has to be paid out to that person. So why aren't they? Yeah,
if a pension fund has turnover of more than 10% a year, they ought to re-examine what they're all about. It just doesn't. They don't need to do it, but you have the whole world telling them they need to do it all of the time. You have the best salespeople in the world working on them, telling them if you just pay us a big enough fee and we trade often enough, you're going to be a hero. And it isn't going to be true. I mean, the people that are sitting in this room that I'm talking to, over the next 10 years, if they match the S&P, that's as good as they're going to do. And that's going to be their gross result. And if they pay a lot of money out to other people, their net result is going to be worse.